Good afternoon and welcome to Markets Today. I'm your host, Odhiambo Ramogi. We have experienced a turnaround in the market this week with an all-share index in the green, and of course the FTSE in the green, and it's a wonderful, wonderful week to be an investor in the stock market. Today, however, we want to focus our conversation around one, the bond market, and two, the reality of the debt, the public debt in Kenya. And I will be joined by an analyst to have that conversation. But before that, as usual, we'll take you to the market, have a look at how the market has fared on. We'll start with the gainers of the day, and I can report with authority that Unga Group is the top gainer of the day, up 10%, followed by HF Group, that is up 4.36%, closing the day at 3 shillings 44. The third gainer is Samia Africa, which closed the day at 2 shillings 77, being 4.14% up. Flame Tree closed the day at 1 shilling 38 cents, being 3.76%. Home Africa closed the day at 38 cents, being 2.7% upwards. We go to the losers. Well, it looks like the steroids that were running Car and General are finally over. And so Car and General, the supply outstripped demand, and it closed at 57 shillings, being 8.43% lower. Uchumi supermarkets equally had a bad day in the market, shared off 4.35%, closing at 22 cents. Nairobi Business Ventures closed the day at 495, being 3.7% lower. Stanbic Holdings closed the day at 87 shillings 25 cents, being 3.06% lower. TransCentury closed the day at 1 shilling 24 cents, being 2.36% lower. The movers of the day, as usual, we start the day with Equity Group, which moved 2 million shares. It's the leading one today. WPP Scan Group made it to the Big Boys Club today, having traded 1.6 million shares. Kenya Power and Lighting retained its preeminence up in this list, having traded 1.4 million shares. Safaricom PLC can never miss 1.1 million shares, and KCB Group also traded 351,000 shares. What a week. Well, to join me in the conversation around the issue of public debt is none other than Churchill Ogutu, who is an analyst based here in Nairobi. Churchill, welcome to the show.
Thank you for the invite. Happy to be on the show.
Lovely. Well, start us off with an update of how the bond market fared today and especially in the course of the week.
Thank you. Let me walk you through the update over the course of this week. That's between Monday and Thursday. We are still yet to receive the numbers for the day's action. But basically, we are seeing drying up in the secondary market activity. Week on week, we've seen a decline of 47%. That's compared to what we saw over the course of last week. And majorly, what are the trading? What bonds traded over the course of these 4 days so far? You've seen that the infrastructure bond segment has had some heightened activity. I think this is the second month, getting into the third month running, that we've seen elevated activity in the infrastructure bond segment. And we saw quite healthy flows in Monday session. That was basically in reaction to the announcement that was there last week with the new infrastructure bond issue. But over the course of the last days, between Tuesday up until yesterday, there was still some heightened activity in infrastructure bond segment. Apart from that, there was also activity in a bond that is maturing in 2041. That was a 20-year bond that was issued last year. So that those two segments, the infrastructure bond, I think it accounted roughly over 45% of the week's activity up until yesterday, and followed by this 20-year bond. So those are the more or less the highlights of this week so far.
Thank you. Do you think that perhaps the fact that the bond market has been inactive is what is reflecting on the other side of the stock market, with stocks now attracting investors?
It's a bit balanced in the sense that most of the activity in the equity side is dominated by foreigners, whereas if you get into the fixed income side, basically it's a domestic affairs activity. So it's more or less a balanced effect, whereby not a similar basket of investors are trading on both sides. So you might find that what foreigners perhaps are looking at the equity side is different from even what the local investors are looking on the fixed income side.
Pretty much, I understand. It's not a trade-off, so that if this one is receiving, this one is losing ground.
Yes, yeah.
I hear you. Now, we have a debt situation in Kenya with figures indicating that we're probably getting to 70% of GDP anytime soon. Could you perhaps start us off with just an overview of the debt situation in Kenya?
As at September last year, those are the latest numbers we have. The stock of public debt was around 8 trillion shillings, whereby it was split 51% to external debt and the other 49% to domestic debt. So that's quite where we are. I think by mid this month, it's essentially the next week, we should be getting the data up until end of last year. But it's quite an upward trajectory we've seen over the last 2-3 fiscal years, whereby it's still grinding up and higher and closer to hitting that 9 trillion ceiling. So it's quite at an alarming level. Public debt to GDP, based on the numbers up until September last year, we are at 68% of that. Still, closer to that 70% mark. So it's quite elevated, the stock and also the debt burden, if you compare the nominal debt to the nominal GDP number.
Which countries are we indebted to in particular? Initially, I thought it was just China. It looks like it's a global affair.
Yes, it's quite spread out. In terms of external debt, there are 3 categories of creditors. The first one is now the multilateral lenders, that's the IMF, the World Bank, whereby World Bank is quite dominant within that multilateral space. They've been lending Kenya, I think, way back since 1970s. Even if you look at the public debt register, the World Bank stock debt is still ranking highly. So the second lot is now the what we call the bilateral lenders. And China, I think, under that bilateral creditors, I think the total stock is around 900 billion, whereby Chinese stock is 600 billion. So 2/3 of the bilateral credit is now from China, which is quite a massive uptick. Remember, like even 10 years ago, at the beginning of the last decade, that's 2010s, China was nowhere even in the trade segment or even in the debt segment as a creditor nation. But right now they have come and overtaken some of the traditional bilateral credit nations. So Chinese is one of them, quite outsized. And then the last component of that is now the Eurobonds, commercial financing. Basically, that's where the Eurobonds, the syndicated bonds, the export financing falls in. And just to give you a flavor, the biggest chunk of that is now split between Eurobonds and the syndicated bonds. That's a split between 60% on Eurobonds and then the other 40% to syndicated bonds. So that's basically how our composition of our external debt looks like.
Well, it doesn't look quite attractive. But on top of this now, the central government has issued a 76 billion bond, infrastructure bond, looking for you and I to give them more money, because you've intimated that a majority of guys who buy into the infrastructure bond are actually locals. How will this affect the total debt stock in the country?
Yes, great question. And if I take you back to, I mean, all this financing, be it external or domestic, comes from the budget. And we're talking about the current financial year, fiscal year 2022. So the numbers, what we're looking at for the total financing, it was around 840 billion, split between external and domestic. And now the biggest chunk of that is now on the domestic financing, whereby Treasury or the government was seeking to finance from domestic sources 659 billion shillings. So that's been what they have been coming to the market on a monthly basis, on a weekly basis. Monthly basis, they come to issue T-bonds, Treasury bonds. On a weekly basis, the Treasury bills. So that basically now comes into the domestic financing component. Obviously, there are some maturities that come along, but basically they're looking at a net financing of 659 billion over the course of this financial year. So that's the starting point. So each and every month they assess the market, what bond should they bring. Unlike other markets whereby they have a calendar of what bond will be auctioned, in the Kenyan market, in any just before they issue a bond, there's a committee that sits and assesses which particular bonds needs to be floated. So I think when getting into the February auction or February month, they assessed and then they looked at IFB, infrastructure bond is the best bond to issue. Based on what we've been looking at, as I mentioned earlier, from December, January, and getting into February, there was lots of infrastructure bond trading. There's an existing infrastructure bonds that are there in the market, but those ones, they kept on trading like the non-infrastructure bonds. So at least to increase that supply, that more or less necessitated a new infrastructure bonds to be issued, and that's what's played out. So far, I think the borrowing, out of that 659 billion that they seek to raise during this financial year, as at the end of last week, just my quick calculations, I think it's around 60% or roughly 390 billion already has been raised. So as they come in to issue 75 billion infrastructure bond, that's now what they want to get. Probably because of the high uptake of infrastructure, they might do like a green shoe option. And this is coming from the fact that the last infrastructure bond that was issued in September or August, about last year, they wanted 75 billion, they ended up picking 105 billion. So that difference is what's the green shoe. They don't tell us, but obviously we can see from the results that comes out.
So it's possible this will be oversubscribed and they will still take more money than 75 billion.
Yes, there's a likelihood that there'll be that subscription. Looking at the fact that most of the activity, foreigners will be looking at the infrastructure bonds, and even the local guys, the banks, mostly the pension funds, 75 billion cumulatively across all these heterogeneous class of investors, it's quite an easy sell for them. So it could fly off the shelf. They'll get that 75 billion. They could even get more than that, but now they could now tap into that green shoe, at least to get over and above that 75 billion that they want.
I'm highly uncomfortable with us taking more debt just to finance budget deficits, which in fact just contributes to the problem of debt we already have. Isn't this perhaps worrisome?
Yeah, it is worrisome, but it all boils down to where our budget is. Because essentially the way that we get into the debt is because our revenues are lower than even the expenditure that we want to get ourselves into. Having said that, there's been at least some positive performance in the revenue side, but nonetheless, this whole, if you look at it from the holistically, you can see that the expenditure is way surpassed the revenue. So that just means that you can't run away from the debt. But now it depends, okay, which debt are we getting ourselves into, or how sustainable and the
Is the
projects
debt
that will
situation is
be
yeah,
funded
because
from the debt.
I get the feeling that these guys are just floating infrastructure bond because there's demand for it, not necessarily because there is a good analysis that it will create the sustainability around debt as we need it. Some of these infrastructure that they want to invest in take ages before they can turn around, and between now and then we are not so sure about debt sustainability. Churchill, are you there? Have we lost Churchill? All right, it seems like we have lost Churchill. I was having my discomfort around debt. I was sharing my discomfort around debt. And the fact that the 76 billion infrastructure bond is bound to affect us in not a so good way because it's just going to add to the debt stock. There is the sustainability question that we still don't know about. There is the issue of crowding out, and I think when he comes back, hopefully he will come back, then we can discuss the fact that some of this debt that the CBK issues really create what we call crowding out effect. And so it's a conversation. Churchill, are you back?
Yes, sorry.
Okay. I was asking, and rather I was just discussing the fact that these guys seem to float the infrastructure bond purely based on the fact that there is demand for it, and not necessarily because they have calculated the sustainability around that bond and the many other debt elements that they have in their stock.
Yeah, that's also a good angle to look at it. Because previously, if you look at the infrastructure bond prospectus, they get the details that this amount of money is what we are seeking, and then this 20 billion is going to roads, this 30 billion is going to water. But nowadays, you don't see that granularity as to where the projects or the sectors that will benefit from that. So it's basically like infrastructure bonds on name, but you can't even tell whether they are getting into the projects themselves. There's, I think that not the last year, but the other financial year, whereby Budget and Appropriation Committee said that going forward, Treasury should be submitting a list of the projects that will be benefiting from all the funding, be it external or domestic. That was put, it was passed, it was a resolution that was passed, I think, when they were passing a budget policy statement for the year 2020. We haven't seen much coming out from that, so that is just increasing the concern that we are doing an infrastructure bond for the sake of an IFB, because there's usually elevated demand for that paper, but not necessarily getting into the infrastructural projects.
Yeah, pretty much. I want to, perhaps before we go for our break, I want to bring it to the point of the crowding out effect. We have seen many private sector players complain that private credit is not progressing as it should because government is taking away all the money from the banks. And this is in fact interfering with economic growth. It's in fact with interfering with businesses and generally the well-being of the economy. What is your take on this?
Yeah, absolutely agree with that analysis in the sense of, if you look at me and you, deemed as a risky borrower from a bank's perspective, and then there's a government which is deemed as a riskless borrower. So from a risk, from an asset allocation perspective, you'd find that the banks will be biased towards lending to the government as opposed to you and me, because they deem our risk profile is quite riskier than the norm. So that from that level, you find that banks will still continue shoving their assets to the government securities. But having said that, and just to bring some nuance to it, right now there's what's called the risk pricing model by that was supposed to be approved by the Apex Bank. That hasn't come out. So from a bank's perspective, they cannot really price risk to any borrower that comes to access credit. So that more or less impedes them into that credit mediation role of banks, and hence you can't even, it's a no-brainer for them if they keep on lending to the government. So that thing continues playing out, the crowd out of effect, and looked at against this background whereby we are still not yet out of this pandemic. There's still risks around the corner. So banks tends to, in this environment, they would rather just lend to the government as they wait out. We are getting into political scene. Well, we've been in political scene anyway the last 3 or 4 years, but now we are getting into the heat of things. So probably even going into some outlook, they may be more they might have a wait and see approach as opposed to lending out to risky segment of the society. So they'll still continue lending to the government.
Well, I find it interesting that I am risky. That would sound more poetic. Risky Ramogi and risky Churchill being crowded out by the government. On that risky note, I think we should take a break. When we come back, we'll talk more about that risk-based pricing that that banks are proposing, and several analysts are opposed to. We'll also talk about the Eurobond and the many other bonds that the government is issuing. Don't go away.